This episode is brought to you by AlphaSense, the AI platform behind the world's biggest investment decisions. The right financial intelligence platform can make or break your quarter. AlphaSense is the #1 rated financial research solution by G2. With AI search technology and a library of premium content, you can stay ahead of key macroeconomic trends and accelerate your investment research efforts. AI capabilities like smart synonyms and sentiment analysis provide even deeper industry and company analysis. AlphaSense gives you the tools you need to provide better analysis for you and your clients. As yet another value podcast listener, visit alpha-sense.com/FS today to beat FOMO and move faster than the market. That's alpha-sense.com/FS.
All right. Hello and welcome to yet another value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review, follow it wherever you're watching or listening to it. With me today, I'm happy to have on my friend, Brad Hathaway. Brad, how's it going?
Great to be here, Andrew. Looking forward to chatting.
Brad is, what's the title I give you? CIO of Farview? What is it?
Yeah, I mean, I guess I consider myself the managing partner. That's how I refer to myself, but yeah.
I never know. Well, here, I'll tell you, before I do the disclaimer, I'll just tell you, so I launched the podcast 3 years ago, and you and I, we exchanged a few notes, but I think we met over the summer of 2021. And then when I was like, okay, I really like the podcast. I want to keep doing it. I want to like start getting them edited and stuff. I put together a list of people I wanted to have on, and I think your name was number 2 or 3. So it's taken 2 years, but finally got you on here.
Well, very kind of you, Andrew.
We've got a really fascinating one to talk about today. But before we get there, I'll just give the same disclaimer I do to every podcast. Nothing on this podcast is investing advice. Neither of us are financial advisors. Please consult a lawyer, consult a financial advisor, anything you want to do, but not financial advice. That's particularly true today because we're going to be talking about a company that's pretty big, but the stock is quite illiquid because insiders own so damn much of it. So, people should keep in mind that illiquidity carries an extra degree of risk, but this isn't financial advice, so that doesn't really matter anymore.
Can I just add to the disclaimer quickly? I mean, I think, it's important to remember that like every investor, I'm wrong frequently. There's plenty of evidence of that. And also, I've at least found through my career that if I just buy something on someone else's advice and I don't do the work, then I'm actually not going to hold it through the volatility. So my ability to get those returns is almost zero. So it's kind of like if you buy something based on what someone says on a podcast, you deserve what you get.
I've talked about this frequently. Like if you listen to a podcast, look, I run a podcast. I hope it gives a lot of value. I get a ton of value out of it. But if you went and bought something off a podcast, and again, we're not saying you should, but they report a weak quarter and the stock's down 10%, you are probably going to sell, or you might buy more. Whereas if somebody who's done the work, they're going to know, oh, down 10%, just a blip, buy more. Or they're going to know, oh, this was a thesis ruiner, I need to sell. Like you'll make all the wrong mistakes because you haven't done the work, you have no conviction. But having had, knowing that you are one of 3 people who are asking questions on the Q3 earnings calls, company, I know you followed for a long time. The company is Distribution Solutions. The ticker is DSGR. They used to be Lawson Products, so I might accidentally call them Lawson once or twice. But this fascinating company, I've got so many notes, but why don't I just flip it over to you to give a quick overview about Distribution Solutions and what's so interesting about them?
No, absolutely. As you mentioned, so I've followed this company for almost a decade now, back when they used to be called Lawson Products. And in 2022, they basically went through an interesting 3-way merger where their major private equity shareholder, Luther King Capital Management, combined Lawson with 2 other distribution businesses that own Gexpro Services and Test Equity. And in short, the reason why I think Distribution Solutions Group is really interesting, and again, disclosure, I own this, is it's basically 3 really good businesses with that are basically niche specialty distribution businesses that have a really interesting runway for both organic cash flow growth through revenue growth and margin expansion, very accretive M&A, leading to long-term cash flow compounding. And on top of this, they're run by a heavily incented, well-aligned majority shareholder who has a tremendous amount of experience in the distribution space. So both you have the alignment and the expertise to help with the organic initiatives and the M&A, which I think is a really compelling setup.
Yeah, I agree. And, I guess the other thing we should talk about is let's start with maybe just the overall setup with the owner and stuff. So there are a few things I want to hit on. First, there was a rights offering over the summer. And, anybody who's read You Can Be a Stock Market Genius, which I maintain is the best book for investors who are looking for like kind of modern value investing, event-driven investing. those rights offerings should cause you to perk up. Do you talk about just the rights offering over the summer, just to give a little bit of background on that before we dive into everything?
Yeah, so they did this combination in the spring of 2022. And, initially the stock kind of reacted well to it. But then for some reason, I think just kind of in small cap malaise in Q3 of 2022, the stock really got hammered. I mean, declined like 30 or 40%. And so Brian King, who's the head of Luther King Capital Management, the goal of this has always been to, basically he's got 3 verticals and he wants to acquire companies in each vertical to continue these kind of roll-ups because of the massive accretion one could see with well-done M&A here. The problem is he's also committed to a 3 to 4x leverage target because he wants us to be reasonably levered because it's, a huge position for his family, a huge position for his fund. And so they found a great deal that they've been searching for years. A company called Hisco finally was ready to transact in the spring of 2023. And they didn't want to go past their kind of 4x leverage target. So they wanted to raise some incremental equity. But the problem is Brian didn't want to give equity out at the multiple they were trading at. So the theory was, okay, what's the best way to do this is let's explain to everyone the opportunity we see and give them a chance through the rights offering to keep their proportional ownership of the business so that no one gets diluted, no one's effectively selling stock at a low multiple. And LKCM, with Luther King Capital Management, I'll probably refer to them as LKCM a fair amount, they were going to backstop the rights offering because they were like, listen, we think this is incredibly compelling. We're going to make sure this rights offering is successful, but we want to give everyone else the opportunity to come along if they want.
Well, so I just mentioned, I probably put the cart before the horse by mentioning it, but everyone who does venture investing knows when there's a rights offering, you've got to look. And look, one of the most interesting things here is, as you said, LKCM does the rights offering. They're huge shareholders. They oversubscribe to the rights offering, if I remember correctly. And let me just see if I can find the one quote I really liked about this. I'll find it and go with it later. But so let's talk about the business. So there are 3 different verticals here, but this is basically specialty distribution. Do you just want to talk about the overall business? And I think people might get really jazzed if you start talking about some of the comps that, might not be in the exact same verticals, but some of the comps and the compounding returns that you've seen with these types of things.
No, absolutely. And I think, so we'll start off with the idea that specialty distribution as opposed to more kind of broadline distribution is something where it's either scarce parts, complex supply chains or complex sets of parts, or very much kind of niche products. So it's not something you're going to be buying on Amazon. It's not something you're going to be, really easy to get. And so what that means is you have a fair amount of expertise, you have a very knowledgeable sales force, and there's a fair amount of initial services that kind of come along with the actual distribution of the product. And in this case, it's actually even more service-oriented than that, because I think the core underlying part of the business here is something called vendor managed inventory, or VMI. And so what that means is effectively you are outsourcing your supply chain for this particular set of products to the vendor. Lawson has been the classic example of this. So the way to think about Lawson is they do vendor managed inventory for maintenance and repair organizations. So what that means is, let's say you are an auto mechanic. You would have a wall of bins with various SKUs, and we're thinking fasteners, we're thinking screws, we're thinking chemicals, we're thinking abrasive tools. And that wall would have the inventory. And if Lawson is doing their job properly, if the Lawson salesperson is doing their job properly, you never have to pick up the phone and order something, because the salesperson is visiting you on a certain number, either it's, every couple of days or weekly. And they know your business well enough that they are anticipating your needs. They're saying, Andrew only has 30 fasteners left. I know he uses 35 over the course of the week. We need to up that so he never runs out of a fastener. But Brad has 30 fasteners, but Brad only uses 15 in the week, so I can wait till next week to fill them. So what that means is it's incredibly service intensive, and what it saves you is from having your $100,000 a year mechanic spending time unpacking boxes, spending time running inventory, because you have outsourced that to your Lawson salesperson.
Go ahead.
I was saying, as a result, and I'm going to start with Lawson, and I can kind of move to the other ones. As a result, Lawson historically is around 55 to 60% gross margins on parts that have an average selling price of about 90 cents. It shows, these are the service intensive nature is really what gives that. And then so just continue on the BMI.
Well, let's stick with Lawson real quick, just because you were talking about. I think there's two. Correct me if I'm wrong, but it's not just, hey, you don't want your mechanic who their time is best spent spending 3 hours repairing a car or a truck or whatever. It's not just that. It's also, hey, if you ran out of a fastener, right? If it takes 3 hours to repair a car, you run out of the fastener, you have to call, get a new one delivered. That car, instead of sitting there for 3 hours and kind of churning, is now sitting there for 2 days, and like you're losing all sorts of revenue. That's one piece of it as well, right?
A better way maybe to phrase that is United Rentals. Is one of the biggest customers of Lawson. And you don't want to have a multi-million-dollar excavator sitting idle because you're missing a dollar part. And so, yeah.
And then, so let's just talk about the Salesforce dynamic as well. So if you were the salesperson, right, like literally what it is you would come to my garage or whatever, you would literally go in the bin and say, oh, Andrew only has 10, he needs 35. You would actually just, without insulting me, you would toss 25 into the bin, and then you would charge me for 25 fasteners, right? So there's also like a real degree of trust that you're charging me for 25 fasteners. And I was thinking about it the other day, because as you said, like some of these things are $1 apart, right?
Yeah.
It would be so easy for you to charge me for 30 instead of 25. I don't even know how I'd audit you or catch you. Like there's something about that degree of trust that I think is really interesting. I don't know if you want to add anything there or anything.
Well, no, and I think a lot of it is these are, a lot of Lawson sales reps are very long tenured. So, and these are route-based businesses. So, if I'm your sales rep, I'm seeing you, Andrew, every week, and I'm on, and so there is that element of trust that's built over the years. And if you're a good salesperson, making an extra 30 cents on adding one extra screw to your order, is that really worth potentially ruining a relationship we might have over a decade where I'm going to sell you 50,000, 75,000 screws?
How would you get caught adding the extra screw? Because I even thought about like,
well, eventually if you're the mechanic and your bins are overflowing with stuff you're never using, I think that leads to questions. Because again, you're going to see how many products are there and how many are whether or not they're being properly used.
I more meant like
over this, but yeah.
If you charge me for 26 but only put 25 in my bin, right? Like how would you ever catch somebody when
that would be caught on the Lawson side, because in theory, those number of 25 should come out of their inventory, and if there's 26 on the purchase order, there'd be an inconsistency there.
Okay.
And obviously Lawson as an organization is very aware that the trust of their customers is one of the most important things they have. So
the reason I ask is because, and I'd love for you to dive into this comp. Obviously, they've provided a set of peers and the multiples and stuff, but every investor has seen like there's the HBS or Barron's cover story that's Facet. What's the best performing stock over the past 30 years? Like I think it was in 2018. It was like, it's not Apple, it's not Amazon, it's not any of the company, it's Fastenal. And it's like, what do they do? They're in the exciting business of they distribute screws, right? And so I mean, that's a direct comp, very similar model. I think slightly different end markets, but very similar model to Lawson. Correct me if I'm wrong.
Yeah, a little more branch-based where they do, they have their retail, not retail location, they have their branches that they're distributing at, whereas Lawson is more route-based. But effectively they are a lot of similar parts. Lawson is a little more of a mom-and-pop customer base than Fastenal. So they are, there's a fair amount of overlap in the Venn diagram there. Yeah,
but obviously like, look, when you say, hey, we've got a similar business, the trust-based business, the dollar or less parts to the best performing stock over the past 30 years, you're like, hey, here.
And now a quick break to remind you that this episode is brought to you exclusively by AlphaSense, the AI platform behind the world's biggest investment decisions. AlphaSense gives you the tools you need to provide better analysis for you and your clients. As yet another value podcast listener, visit alpha-sense.com/FS today to beat FOMO and move faster than the market. That's alpha-sense.com/FS.
So let me ask, just with Lawson, with this DSGR, obviously there's a lot of trust with the relationships, but what is kind of the secret sauce that we'll talk about the returns on capital and stuff? Part of it is the trust, but sales forces can be poached, right? It's not like it's hard. You and I could go tomorrow and buy, I'll chip in $4,000, you chip in $4,000, and we could buy a bunch of screws and maybe hire a salesperson, or we're both pretty outgoing. Maybe we could be the salesperson. What's the secret sauce that kind of gives them advantages as they scale and lets this business compound?
Well, one of the nice things here is it really is a many-to-many distribution. So we're talking about 170,000 customers, 500,000 SKUs, and 7,000 suppliers. So you have a lot of area. It's not just you and I can go buy 4,000 SKUs. We have to be able to distribute a huge number of parts from a huge number of suppliers. And at Lawson, their biggest customer is only 3% of revenue. So it's not like we can poach one big customer and say, oh, we've done it. And so it's this idea of this many to many where the distributor really adds a lot of value because you have the challenges of kind of corralling the many players on the supply side between the number of suppliers and the number of SKUs and managing that, and then also managing the number of players on the demand side. And that's where really this person in the middle could add value.
I was wondering, so here you go on all that. I was wondering how much of it was like you mentioned route-based density, how much of it was like a logistical advantage as you scaled up? Because like if you and I started and we managed to poach a customer, two customers, one on each end of town, like we'd spend a lot of time driving. And then if it was only two customers and we had to service them, each customer once a week, we'd have so much downtime. Whereas if Lawson has, 100 customers on each part of town, then the salesperson can be like, hey, Mondays you go to the west side, Tuesdays you go to the midtown. Like how much is the density an advantage for them?
No, it's absolutely a huge advantage. And actually one of the interesting things they've been doing with the new CEO, Cesar Lanuza, he's come in and basically kind of moved a bunch of their smallest customers that were basically uneconomic to their inside sales force and their digital channels, with the idea being that, even with the existing route-based business where Lawson has this advantage, there are still customers who are relatively inefficient for them to service because they're only ordering $500 worth of parts, but it's a 45-minute drive and whatnot. And so this idea of basically gross profit dollars per unit of salesperson time is absolutely critical. And so if you don't have that density, then the gross profit dollars you're going to be able to get are not going to offset the time your salesperson has to do to basically manage the business. And it's actually been one of the historic challenges for Lawson has been getting new sales reps up to speed. They used to have a chart in their old decks. Basically, the productivity of a seasoned sales rep, which is effectively year 3+, was kind of 3x, I believe, if memory serves, the productivity of a year one of a completely new greenfield sales rep. And so those first sales reps were effectively uneconomic, but Lawson would make the investment in them to try to hope that a certain portion of them would become seasoned sales reps. So starting a business with a bunch of unseasoned sales reps, you'd have to be willing to burn money for a fair amount of time.
Perfect. I've got a few more questions. Why don't we go to the other two businesses and then I'll come back to that.
And I guess, just continue on. I mean, I think, again, the core concept throughout this is this concept of vendor managed inventory. So whereas Lawson does vendor managed inventory for the maintenance and repair mechanic, Gexpro Services does basically vendor managed inventory for OEMs. So,
and these are all still small dollar figure inventory.
These are bigger dollar figures. I think it's like, because again, you're talking about like building a big gas plant somewhere or working with a big renewables company. But what's really interesting is I believe it's 70% of their products are specifically engineered for the customer. So it's a very collaborative relationship. It's not like you're buying a screw off the shelf. You're basically working with the customer and saying, what do you need for this factory? Okay, we will go source and create that for you. And that's become a very sticky business. So Gexpro has 98% customer retention because they're really a collaborative partner that is finding the parts for this. And they made a comment in the investor day, something like I think it's 25 to 30% procurement savings that an OEM gets from going with Gexpro.
You mentioned 98% customer retention ratio. I mean, would I be right to say the only reason somebody's going to leave this once you kind of get inside there is basically the business goes belly up or maybe gets taken over by someone?
Yeah, I think that's generally the case. And so Gexpro is 98, Lawson's in the low 90s, like 92. And Lawson has the incremental thing of occasionally like a sales rep goes to a competitor. And so given the relationship nature of the business, but yes, generally the benefits of this are and there's also a small chance wherein the service levels are poor or something like that, but that's very rare. I mean, these are very, very sticky businesses, which is one of the main benefits here.
Want to hit the third business real quick?
Yeah. And so then the third business is Test Equity. And so part of their business is vendor managed inventory for electronic production supplies like solder and things like that. And that's actually becoming an increasing portion of their business with the acquisition of Hisco, which was a pure VMI business. And so again, it's, for aerospace and defense, for electronics, things like that, they are basically providing, a lot of these kind of low dollar price parts but actually in this case, even have more expertise because like solder is a very complex product that you need some real knowledgeable sales force to distribute. They also have another business, which has been a little bit the source of problems, that they distribute test and measurement equipment. So you think you have Keysight equipment, Rohde & Schwarz, Tektronix equipment. And that is the one part of the business that's a little more kind of capital cycle tied because, I mean, obviously these are a couple $100,000 pieces of equipment. And so that's the only kind of part of this. It's not really vendor managed inventory, but it is now a relatively small part of the overall mix because of the, post the Hisco acquisition.
So I think you first mentioned Lawson to me probably 18 months ago. And this was right when the three businesses got combined. And I guess, the first thing was I kind of looked at it, I was like, oh, I get what Brad's saying, but, I'm always a little skeptical of, and we'll talk why the inorganic growth makes sense in a second, but I'm always a little skeptical of inorganic growth stories. And then I was kind of like, LKCM took a public business that they controlled and combined it with two private businesses they controlled. And I was just kind of like, Brad's probably right, but life's too short. And then I will say, as people will hear, I got super excited when I read the analyst day and prep for this, but I was kind of just like, life's too short. So I want to ask two questions on that front. Yep. A, what gives we've probably mentioned a few of it already, but when I just lay out, hey, publicly controlled company merging with two privately controlled companies, I mean, that's not a red flag. That's like a red skyscraper, right? So what gives you confidence there? And then on top of that, I want to ask you that once we get past that, the main question is actually, hey, why do these three businesses, which are all VMI, but which are serving completely different customer bases, why do these three businesses belong together? Because the company is definitely pushing, there are synergies, there are reasons to belong. You kind of have to think that first. So I'll turn it to you.
No, absolutely. And I'll start maybe on the kind of why piece, because I do agree, there's obviously been a lot of examples of like a private equity shareholder taking advantage of minority public markets investors and whatnot. What was interesting to me here is, a couple things. One is LKCM did not take any cash out of this transaction in any way. In fact, they took entirely stock. So they went from controlling 40% of Lawson to basically 65% of this business, and really kind of tied themselves to the mast in terms of, this is roughly 35% of their funds. It is a massive position for them that they need to make work. And what we've seen is also their behavior since owning has been incredibly shareholder friendly. So Brian King is now the CEO of DSGR, and he takes zero cash compensation. He's not taking, as opposed to, I'm involved in a couple other roll-ups where all of a sudden the management's making a few billion a year and they're getting bonuses. And
they say, hey, if the stock goes up, we make a lot of money. And then you have to be like, yeah, but if the stock goes down, you still make a lot of money.
I have a different one where the founders stepped back and hired a new CEO, and they took, multi-million-dollar paydays as their quote to step back. And, I was like, okay, guys, you own a large percentage of this company. Did you really need that extra multi-million-dollar payday? And so Brian has taken absolutely no cash compensation. In fact, LKCM is taking no management fees for any of this, and they are contributing significant expertise in terms of both their M&A teams and their basically operations team. They have an operations improvement team, and they're basically not getting paid for any of this. So not only are they not taking advantage of shareholders, but they're actually contributing significant expertise for basically no compensation on behalf of shareholders. And so you start to see the behavior, which gives you real comfort that they're actually working on your side. And then when you also things like the rights offering, LKCM could have basically contributed the capital themselves. They could have, in fact, Ryan waited till after the Q1 results, which were really, really good, specifically because he did not want to basically be taking advantage of other investors because he knew Q1 was going to be good. So he waited to price the rights offering until after that, that information was in the market. So we're starting to see enough behavioral things wherein, he's doing the right thing enough times. He and his team, it's not just him, but he and his team are doing the right thing enough times where you really start to kind of build up that reservoir of trust. Again, like the flip, they easily could have also taken Lawson private and done this in the private markets. They have plenty of capital, and Lawson was not richly valued previously as a public market security. So was definitely a scenario where they could have not brought people along for the ride. Instead, they chose to, put out a proxy with pretty aggressive projections to show people the opportunity they saw, and then do things like hold this investor day where, as a public market CEO, you are taking on some liability by putting aggressive targets out there. And Brian got up in front of the investing public and said, $5 of EPS in 5 years. That is for someone who's not getting paid a dime for spending that time, he's taking on risk. So what gives me comfort effectively has been the behavior of them throughout. Now, obviously, it is something to keep an eye on, but at this point, as opposed to, and again, unfortunately own a couple other roll-ups where the behavior has not been as good. I have not seen anything that's given me any discomfort.
Yeah, no, I'm completely with you. I would encourage anyone. I read the analyst day and I was like blown away. It was one of the best analyst days I've ever seen. And I'll come back to the LKCM history and story in a second, but let's just talk about why do these three businesses belong together, right? Like, so there is VMIs. If you're acquiring, as we mentioned, there's route-based density. You get a little bit bigger. You get a little bit of pricing power with your suppliers. There are certainly economies of scale within something, but why do three different VMIs belong together?
So the easiest argument is effectively that, Gexpro and Lawson are very similar businesses, just serving different customer bases. And those businesses, and also the kind of VMI part of Test is also very similar, serving different customer bases. And so if you are serving a big multinational, for example, if you're serving General Electric, both they have, and which is Gexpro's biggest customer, because Gexpro stands for GE Experienced Professionals, because it used to be incubated inside GE.
Yep.
So GE is the biggest business. If you are servicing GE for their OEM piece, they're using a different supplier for their MRO piece. And, Gexpro has talked multiple times about how they didn't have an MRO offering because it is a different end market for them. And Lawson has talked in the past about how they didn't have an OEM offering. And so there is significant ability to basically bring your kind of sibling company into a big customer and say, yes, you love us for OEM. Here, this is someone very similar to us for MRO. And so you're seeing a lot of those kind of cross-selling synergies, and you see that as well with the VMI part of Test Equity. The hardest part is the test and measurement business. That's probably got the least synergy, so you can get as a different business model. What they would argue is that that's kind of the tip of the spear in terms of kind of early stage investment, and it helps kind of create leads for them. That's probably the one where there's the least compelling argument. But what we've seen is, the investor they talked about, they have, I think it's 250 opportunities for cross-selling that they think have line of sight to over 50 million of revenue. So there's significant value add in kind of having these businesses introduce each other. For example, Hisco has a very big business in Mexico, and obviously nearshoring means Mexican, and there's going to be a lot of investment into Mexico. Lawson has no business in Mexico, and Hisco is now bringing Lawson into Mexico as a kind of, if you're doing, they're doing the electronic production supplies. Lawson can help with the more industrial side of it, and so there's that. And I guess the other part of bringing them together is while these are fragmented industries, there are not enough of them so that each of the verticals on its own can be consistently buying and acquiring every year. And so having three verticals allows for the cross allocation of capital. So for example, when, right now, Test Equity has just done a big Hisco deal. And I think they talked about the investor day, Test Equity probably is not ready for another deal anytime, another big deal in the near future, but Lawson and Gexpro both have plenty of capacity for a new deal. So given that they're under levered right now, instead of having to wait till the Test Equity business is ready for the new deal, they're like, oh, we can reallocate that capital to these two other verticals that have more kind of capacity for M&A. So those are the two reasons.
They mentioned, and I wasn't sure if this was, sometimes they'll get out there and companies will get out there and like throw a small thing out there and it's kind of meaningless, but they mentioned, I think it was, from memory, it was either printing or labeling, and they said Test Equity had like a ton of excess printing or labeling capacity, and by merging, like, we could do that in-house. And look, these are businesses where their target is low double-digit EBITDA margins, right? Like if you're bringing something in-house and saving a little bit of money or leveraging fixed costs, like every little bit actually matters when you're talking about margins that low. But it did just strike me as, I wasn't sure, like, was that just one example of the many they were using, or was that a real thing that they were kind of showing that they could scale up?
Yeah, and there's some of that. There's some cost saving, but I think the real big thing is more the revenue opportunity. Like, for example, also like Gexpro is now manufacturing something for Test Equity that they used to have it manufacture somewhere else that's much more efficient. And they haven't started doing it yet, but there will be some kind of vendor consolidation and some ability to get some cost savings on the side. But in reality, what they really see is the ability to introduce the other businesses into kind of a similar customer base and provide for revenue synergy. So I think that's what and the 50 million is kind of the first step that they say.
We have talked a lot about it, but I think, tell me if I'm wrong, the two pieces of this thesis would be, hey, you've got a specialty distributor trading for 10 times EBITDA and peers you and I can disagree. Mid double digits EBITDA is the number. This is specialty distributor. They've got a lot of room to grow through inorganic acquisitions, which tend to be great for specialty distributor. That would be point one. And then point two would be, and this is the point, again, when I kind of dismissed it 18 months ago, I think I was missing and I didn't realize it until the investor day. I think point two would be LKCM is a killer at this, right? They are an absolute killer. Their track record is unbelievable. Would those be the two, like if I had to boil it down?
I think it's basically, it's a good business in a space that's proven to be attractive for accretive M&A that because of its complexity is trading kind of below where it should. And then you have an incredibly capable steward who so far has proven himself to be trustworthy.
So I just want to go, and again, I would encourage anyone, read the analyst day is so long that I always block off. I've told people this for a podcast, I block off half a day to prep. I blocked off yesterday and then I got a quarter of the way through it because it is a long analyst day. I got through like another quarter to thirds of it. So I'm probably 2/3 of the way through. So I couldn't even get through all of it, but it was so exciting. I'm obviously going to go finish it after this. It was so exciting. I encourage anyone to go read it, but I just wanted to ask you, like, can you give a little bit more about LKCM's history with the specialty distributor? Because again, when you read it in the analyst day and when you see them talking about it, you're going to see what Brad sees and be like, oh my God, this is real. Maybe it's not the best opportunity in history. Maybe it is, but you will at least see this is worth doing work on. This is really interesting.
No, it is one of the things, as you say, like the investor day is very long because one of my favorite things about Brian King is you start talking to him about distributors, and I've had hour-long phone calls scheduled with him that have gone for 2 hours and a half because once he starts talking about the distribution businesses, he gets really excited, and that's because he both has a tremendous amount of history. So LKCM, I'll back up for a second. LKCM is basically the private equity arm of Luther King Capital, or this is LKCM Headwater is technically the entity in control of this, and that is the private equity arm of Luther King Capital Management, which is a Dallas-based money manager, multi-billion-dollar, long track record. Brian King is the head of LKCM, and they've been doing basically distribution M&A. They've been doing distribution acquisitions for over 20 years now.
Direct quote, we've spent the last 20 years focused on specialty distribution and building scale there and knowledge, and we've been able to attract a really resilient ecosystem of operators and coaches who are investors in DSG. That was the quote that I thought was like the most interesting quote to me from the analyst day.
No, I mean, so I think it's 16 or 17 companies. I think the ones they still own, I think they merged with 5X, and the ones they've exited generally got a 10X.
Yep.
So really strong IRRs in this distribution space. So a ton of historical institutional knowledge. And as you said, I think the comment during the investor day was like, they've got like 100 specialty distribution executives in their kind of advisory / limited partner pool. So there's a tremendous amount of knowledge. I mean, I think they talked about Hisco was something where one of their guys was the executive coach to the number 2 at Hisco. And so they had incredible insight in the business, and so they have this expertise about this specific area, and they have a ton of history of doing it and a ton of history of doing success. But it's also not just that. I've spoken to employees who say, when you talk to Brian about distribution, it's been the same experience I've had. He is A, incredibly knowledgeable, and B, really loves distribution businesses. So his breadth of knowledge and his excitement about the space, he means that his excitement means he's excited to continue learning about the space. But he's a guy who understands both, has a lot of history with all the companies in the space, understands what great looks like for a really good specialty distributor, and has the network to both source really good M&A deals. I think they don't get Hisco without his network. They don't get PartsMaster, which was a deal Lawson did a couple of years ago, without his network. They actually heard about Gexpro when it was part of Rexel, which is a French conglomerate, and basically figured out a way to carve it out of Rexel, which became Gexpro, which is this incredibly attractive business. So his knowledge of the space means he knows how to run the company as well. And his knowledge of the industry means he has access to opportunities that you and I are never going to see, because we're not going to know, oh my goodness, there's a great little distribution business that's 3% of revenue at this French conglomerate. Can we convince them to sell it to us? And so having someone with that kind of expertise run both run an M&A thing, I think is critical, because obviously one of the risks of M&A is generally the sellers know more than the buyers. In this case, there's still a lot of obviously seller knowledge, but Brian's known most of these companies for 20 years. And so that gives him a really strong base of knowledge to start with.
Also, and if you believe the scale, there's scale benefits in this industry, like that is the one reason where, hey, you're buying a seller. Yeah, they probably know more than you. Yeah, they've probably tried to front load earnings to get the best price for their business. But if scale is a benefit and you go and buy a company for 10 times and their EBITDA margins are 6 and you can get them to 10 by throwing them onto your platform, by getting more density, like that's how you overcome everything. And as you said, these guys have a history of it. Other specialty distributors have a history of it.
And
let's go ahead.
Sorry, can I just double click on the synergies there for a second? Because actually one of it's not just also cost synergies, it's revenue synergies as well. So if you look at what they highlighted 2 deals in the investor day. They highlighted T Equipment, which was a test equity acquisition. And the comment was basically T Equipment was mainly selling small and medium customers, whereas test equity selling larger customers. And T Equipment didn't have a relationship with Keysight, which is the largest player in the test and measurement space. So by introducing Keysight into the T Equipment business, they were able to massively grow that business and brought down the EBITDA multiple by a full 2 turns within the first 12 months of owning it. Same with Resolux, which was a Gexpro acquisition. Basically, it had a very good European footprint, but in a relatively limited product portfolio. So by introducing Gexpro's product portfolio into Resolux, they were able to massively increase the revenue. So it's actually not even just the cost synergies of bolting it on. It's really, generally what they've said is they only want to buy something with commercial logic, wherein there's going to be significant revenue synergies by, as you say, adding this to part of the platform. And they've got great experience of doing it. Their 22 acquisitions they bought at 7.7x, and within I think it's 15 months they brought down to the multiple down to 6.3x, mainly through revenue growth. And they expect to get at least 2 turns. They're not done yet. After a couple of years, they expect to get 2 turns, and they've got a track record of doing it. So you can. The great thing is you can buy something at 8, but if you can then bring it to 6 through the accretion that your platform is uniquely able to provide, that is highly accretive, and that gives you a big advantage.
Those discussions of multiples actually go nicely into my next point. Let's talk fair value. So I guess the first thing to do is, we've said 10 times EBITDA several times here. When you start thinking parse and everything, you start thinking, oh my God, like those are actual physical things. They need to be stored in warehouses and stuff. But, I think people might be surprised by the D in the DNA here. So let's just talk, 10 times EBITDA, what are you kind of talking about free cash flow? And ignore future growth, all that sort of just let's talk free cash flow characteristics.
I think one of the important things to think about here is actually that specialty distribution is generally a good business. And the reason why Fastell has been such an incredible compounder is because they have a great return on capital. And this business, I think, is trending in that direction. So right now, the return on invested capital is about 16%, but obviously right now they're both under-earning on the EBITDA margins to what they believe they can be. And also, they made a large investment in working capital in 2022 to the supply chain disruptions that they're now working through. So, and they've talked to both of these things extensively in the investor day. So there's actually a really pretty clear line of sight for me to get return on invested capital here above that magical 20% number that kind of signifies a really good business for people. And so that is, I think, one of the things that one of the reasons why these businesses get great multiples is because they have this sustainably really good return on invested capital, and DSGR has that as well. You mentioned kind of CapEx. One of the interesting things here is they're not really manufacturing, they are working with suppliers to manufacture. So CapEx is only about 1% of sales here. And DNA is right now a little over about 2% of sales. So there is a CapEx to DNA gap, but this is not hugely capital intensive. You're talking about 20 million of CapEx on a, just under $2 billion, dollar revenue base. And, it's, basically maybe 10%, it's about 10% of EBITDA. So EBITDA actually flows through relatively well to free cash flow here because of that lack of CapEx.
And just for people who are going to look, there have been acquisitions, but the EBITDA is actually a pretty clean number. In Q3, there was a big, the Hisco merger, there was a big merger add back charge, but you look at the prior quarters, EBITDA is actually a pretty clean number without the Valiant level. We just bought someone, add everything back and all that sort of stuff. So that's pretty nice. So valuation. So we've talked about 10 times EBITDA. It's actually, it's not 10 times free cash flow, but it's pretty close to 12-ish times unlevered free cash flow at 10 times EBITDA. How do you, again, I want to put aside lots of inorganic growth here, but we mentioned peers are kind of in the mid double-digit EBITDA multiples. How do you think about fair value here?
Yeah, no. So, I think if I look out a couple of, so when we talk about also mid double-digit EBITDA for the peers, that generally ties to about a 4% free cash flow yield. So when I kind of think about valuation here, there's 2 ways to think about it. One is kind of, let's look at a couple of years from the midterm. And so if I look at my 2025 numbers, I have north of 200 million of EBITDA, which translates to about.
Well, are you assuming? I'm guessing you're not assuming a big acquisition.
I'm actually not assuming significant M&A.
Okay.
I haven't. I know a lot of people love to build those multiples up. oh, you put in 200 million at 8x, add this, adds 25 million to EBITDA. I haven't done that. So this is more of an organic number where I get to kind of 225 million to EBITDA in 2025. Mainly.
What type of organic growth would this business show without future acquisitions?
So the way I think about this is there is obviously some tie to GDP, because while most of this is not, capital equipment, there still is if you're not using your excavator as much as United Rentals, you're wearing out fasteners less often, you need fewer of them. So there is a little bit of an economic tie, but it's not nearly as intense as most industrial companies. And so you have GDP, and then I think of this as kind of GDP plus plus. And the plus plus is there is a trend from to people increasingly outsourcing to vendor managed inventory for the cost savings they see. There's a trend to moving from smaller players to larger players like your Lawsons, your Gexpros, your Kimball Midwest, your Fastenals. And there's also that, and then so you have the GDP growth, the growth of the industry. You have a significant market share growth for the industry. You have market share growth for these companies within their industry, because they're all very big players in their niches.
How much of the industry is still in-house?
I don't, that's always been tough to quantify. I don't have great numbers on that, but I do think there's still a significant opportunity for moving to a kind of more vendor managed system. Because again, as you say, it's not the easiest thing to do. If you've always unpacked your own boxes and screws, to trust someone else to come and do it for you takes a little bit of, I think, coaching in the beginning. And then the third plus is obviously this cross selling they've talked about between the verticals. So I think of mid-single digit plus organic growth to be on the revenue line to be very possible. And then if you look at the margin accretion percentage as well, that they have credibility on. When they came to this business, the business was, I believe, was like 7.5% EBITDA margin when they first put them together, and they committed to exiting at 10% by the end of 2022, and they're now at 10.6. Now that's in the most recent quarter. Trailing 12 month is 9.5, but this 9.5 to 13.5 path, I think they have credibility with. They've got some clear initiatives that can get you there. So if you combine that kind of mid-single digit top line growth with the margin expansion that comes, it's possible to get to kind of high double digit EBITDA growth. And that's before you start adding in any M&A. And so, so I get to when I get to that EBITDA number, when I work down to cash flow, that gets me to roughly about $3 a share free cash flow. So if you do that, we've said 4% for the peers on 2025. Let's just use 5% now because it makes the math easier for me. So $3 a share free cash flow times 20 is effectively roughly $60 a share. And that's a 2025 number. And then longer term, you have Brian's kind of $5 a share of EPS. And again, we're leaving aside working capital because of the DNA mismatch. Free cash flow should not be too dissimilar from EPS. So then let's say that's roughly $5 a share free cash flow X working capital moves. Again, if you want to put a 20X on that, then all of a sudden over the longer term period, you have that path to 100.
So I always struggle with roll-ups for a few reasons. One, a lot of times the accounting, I don't think that's an issue here. Number two, you mentioned earlier, a lot of times you'll still see people say, hey, I assume they're going to do $200 million of acquisitions every year at 8 times EBITDA. And, they should be valued at 10 times EBITDA. So that's going to create, what is that? That's 2 turns of multiple. That's $400 million of value or something there, right? I don't know if I did that math right, but you see what I'm saying. There's this multiple arbitrage. And I always struggle with that part for 2 reasons. Number one, it's not like the sellers are giving you something at a discount out of the goodness of their hearts, right? Like that's what they think their fair value is. So I never quite know. I do believe especially here, there can be accretive growth, but it's always tough to model. You haven't modeled any of that, so we can put that aside. The number 2 reason would be, hey, the industry multiple is 8 times EBITDA, and we're over here paying 10 times EBITDA, right? So when I say that, I either say, hey, either the insiders are wrong, or we're already paying a premium to account for kind of that accretive growth, or, I guess you could say public markets, because public markets have better liquidity, just pay higher multiples. But I struggle with that a little bit. Does that make sense? Like, if everybody's selling at 8, I want to buy at 7. I don't want to buy at 10.
No, and I completely agree with that. That's the hardest part of the roll-up story is the simple, we buy at 8, we trade at 12, yay, value creation.
There were people who did that in the 70s, right? They issued stock.
Exactly. And when it works, but the minute it stumbles, it can unravel very quickly. And we've seen a lot of examples of that. What I think is actually more compelling here is they buy at 8, but they make 8, 6, or 5. And so you have, this significant growth in the underlying EBITDA of the businesses they acquire. And there's, they have multiple examples of it. I would urge anyone to go back and look at the Parts Master, because again, LKCM controlled Lawson for this. Look at the Parts Master deal that Lawson did before. Look at the Bolt Supply deal. Look at the history of Lawson's acquisitions, and then look at the history of the Gexpro and Test Equity acquisitions they provided. And they have a long history of basically saying we roughly pay, depending on the thing, about 6 to 8 times, and we take out 2x plus in terms of the multiple within a couple of years, basically through the revenue accretion I talked about. And so that also is, and so that's the one thing. One is, it's 8 to the seller, but it's 6 to DSGR because they can run it better. And the second thing is also is then, okay, you do have these opportunities at scale. Hisco, or like let's use T Equipment. T Equipment was too small to get a Keysight relationship. Keysight is the most important player in test and measurement. So as part of Test Equity, the T Equipment business is worth more because it has that Keysight relationship that didn't have previously. Resolux didn't have enough products to become a significant business under their ownership. With part of Gexpro, all of a sudden they have access to so many more SKUs that they are a bigger and more valuable business. So there are kind of returns to scale that I think you should get multiple as a bigger player in these niches. But I do agree that the kind of pure financial engineering part of it is less interesting to me than the fact of the matter that they have opportunities to basically relatively quickly improve the EBITDA of whoever they acquire.
You mentioned scale, so this was going to be my kind of loose last question, but let me ask that. And then I have one more, actually more important question, but let's stick with the scale. The company at their investor day said, hey, there's almost a smile curve, right? When you're too small, you don't have the scale advantages and everything, so your margins are low. Then as you grow and grow and grow, you get more scale, you get benefits. And then the smile curve would be when you start to get too big, you get too complex and you lose some of those scale benefits. So I guess I would have 2 questions for you on that. One, why? Like, why can you get too big? And 2, this company has gotten a lot bigger recently, right? They're still not at like Fastenal or some of these other guys' levels, but they have hugely increased in size. They're rounds up to $2 billion. They're planning to get much bigger, but are you comfortable that they're not close to the negative side of that curve?
Well, so I think, one of the things to think about here is that, while it is one company in the public markets, it really is 3 distinct verticals, and each vertical has its own its own basically customer-facing apparatus. So you have each of the verticals has its own CEO and CFO, and while there's a little bit of back office that's commingled, it's really not much at all yet. So it's actually 3 companies that are large for their, are the leading players in their niches, but it's not like we're actually a $1.8 billion revenue business. It's really, we're more 3 separate businesses. So I think we're far away from the idea of being
even there though. Like we're talking about how each of the 3 verticals can bring the other one's synergies, right? Yeah. You could probably do that at 3. You could probably do that at 5. But like, if you and I were talking, we're like, they have 10 different verticals. It's going to be really hard to get like CEO 1 and 10 and 2 and 9.
I don't think they intend to expand the number of verticals. Right now, the idea is effectively there is a lot of room to consolidate in each of these 3 verticals. So I think the 3 verticals will remain as they are. What I would say is, back to kind of financial engineering public markets, one of the funny things that they always used to complain about when Lawson was kind of small on its own, Lawson, when it was a public markets company, it was like $30 or $40 million of EBITDA. And so spending $2 million on a new ERP really actually hit results and really was impactful. And they talked about, they just are kind of in the process of firing their 5% of their customer base that's uneconomic at Lawson. He was like, Brian has talked about, I could not do that when Lawson was a standalone public company because it would have decimated our share price because people would have thought that we were losing all this business. So there are things wherein it costs the same to implement some new tech or do an investment at a company this size, but you can hide $1 or $2 million of incremental expense a lot better off across 200 million of EBITDA than you can across 30.
The first thing that I've heard Brian say that I don't agree with is, hey, we couldn't do it because people would decimate our share price. Like, he didn't have need to tap the equity markets. He controlled 45% of the company. I would have said like, hey, do it, have a share buyback plan in place and buy the shit out of your shares if people don't get like hey, profits aren't going down. Profits are actually going up as we fire these uneconomic. All right. Two last questions. One is going to be capital. Let's quickly hit capital allocation. Then I'll hit the big one. Yeah. Capital allocation. So obviously they want to do bolt-on M&A, all this sort of stuff. But, leverage is kind of already at their targets. And they've said that there's going to be a ton of cash flow flowing in. I'll let you take it from here. I'll make it a softball, but they've said they're going to be very shareholder friendly going forward. Like, how do you expect cash to get allocated with now that leverage is where it should be?
No, and so, I think they are very return focused. Yeah, if you listen to the investor day, and again, I appreciate you're saying that people should do that because I agree the investor day was pretty incredible. Yeah, they were constantly talking about returns on capital. So, they're talking about getting, investments in working capital to get returns on
50% return on net working capital.
Yeah, exactly. They're like, we're at 35 return on net working capital now. We want to get 50%. So they're talking about like investments they can make, and whether it's an organic investment in the business. Right now, I do believe the majority of the cash flow will go to M&A, which, as long as they continue to do the deals they've done, to me, every deal, the stock has reacted very well to every deal they've done because every deal they've done has been very good. Again, you can look at Hisco, you can look at PartsMaster. When they do a deal, it's generally pretty well received. But they also have bought back shares in the market. They bought back shares late in 2022 when the share price got below 20. Again, and this is, there's a split in there. So they bought back shares in the past. I think that's something they would consider in the future if they can't find other deals. I mean, they've talked about being very opportunistic in terms of capital allocation. Would they pay a dividend? And maybe at some point, but I think the share price has to be far higher than it is today to do that. So I think right now the priorities are, first priority is still M&A. Second priority would be share repurchases if they don't have the other options. And then dividend would depend on where the share price is. And you've seen it. I mean, they have bought back shares in the past.
And now a quick break to remind you that this episode is brought to you exclusively by AlphaSense, the AI platform behind the world's biggest investment decisions. AlphaSense gives you the tools you need to provide better analysis for you and your clients. As yet another value podcast listener, visit alpha-sense.com/FS today to beat FOMO and move faster than the market. That's alpha-sense.com/FS.
All right. Actual last question, and this is not an easy one, but I've got, I think, a mutual friend of ours who owns DSGR. I emailed him and asked him for questions on DSGR, and he didn't respond, so he'll know who he is, and he knows I'm calling him out here. But he mentioned, I think he one time said, hey, look, with DSGR, I've seen specialty distributors before. I've sold them too soon. I'm not going to make that mistake here. We've got a great management team. We've got a long runway to go. If it trades for 100,000 times EBITDA, I'll sell it. But I'm going to ride this as a compounder because I see really attractive long-term returns here, right? So my question is, he's not the only one. You see it. The management team sees it. People who've invested in Fastenal, people who've invested in a pool, there is everyone knows specialty distributors, when run well, and if you buy them at a reasonable multiple, you can compound really well. My question is, what breaks a specialty distributor, right? What causes it to not work, to fail? Because every time I've heard, hey, this model always works, and I'm not seeing DSGR specific, I'm just saying, what would cause a specialty distributor to fail? Has there been one? What's the tail risk that these stop working?
So I think, let's take the longer term, because obviously in the short term, the share price might struggle due to economic cyclicality, things like that. As well, these are stickier businesses. They're still economically exposed. And obviously, if we have a big recession, there will be, the funny thing about this business is it will actually generate a tremendous amount of cash flow, I think, during that period as they draw down working capital, but the stock's probably going to go down. That's a near-term risk. The longer-term risks, you can look at what it's been in the past. So Lawson previously, they used to have their employees were all 1099s, and they had a huge issue with employee kind of alignment and whatnot. They had then moved them all over to be full-time employees, and that caused a tremendous amount of disruption. So one area that can really mess it up is Salesforce disruption. Again,
is it kind of title insurance? I remember with title insurance, when you had agents, and it's a known thing in title insurance that some of your agents will steal from you eventually, and you have to fire them, but they're always accruing for is it kind of, hey, your sales forces are such trusted intermediaries that a few of them will take advantage and you have to account for that, and the worry would be that gets out of hand?
I was saying more that historically, when the sales force wasn't as well aligned, it wasn't full-time employee, they didn't have as much insight. And then you had these people with all these freedom who used to do whatever they wanted. And when they tried to bring them under the corporate umbrella, some of them rebelled and whatnot. And so you have the risk of, one of the things that I worry about with Lawson is, we talked about the value of the tenured sales reps. That's the asset here. Those sales reps are incredibly valuable. And so if you have something like whether some of them are eventually going to start aging out. You're going to have retirements. You're going to have to start backfilling those really experienced reps with newer reps that you're going to have to get up the. And so if you had a thing where you lost a significant portion of your well-tenured sales reps, this is a relationship business. That is a huge potential problem. Also, obviously, one of the things you have to continue to do well is manage inventory. You have to be able to understand your customers' needs. I mean, granted, it's a very short cycle business, but you don't want to get over inventory to the point where you are, where you have a bunch of obsolete inventory sitting on your shelves that you have to start taking provisions for.
Sales reps, I'm just, plumbers. Yeah. Anyone could make a really nice living as a plumber, right? It's not exactly but you're literally managing poop, so people might look down their nose on it. But so there's a plumber shortage, right? And despite the fact you can make a great living, sales reps here, where do they find their sales reps? Is it like when you talk about, hey, there's going to be a retirement cliff at some point? Yeah. Is that replaceable, or is it the plumber issue where, hey, maybe because it's not the sexiest industry, even though I believe the sales reps are all making over $100K a year once they get fully seasoned, is it kind of the issue? Oh, you're going to auto repair shops and dealing with nuts and bolts and oil. Are they going to have trouble replacing that?
Yeah, I mean, I think one of the things Lawson had historically had an issue with was they really tried to aggressively grow their sales force, and they didn't do a great job of onboarding new reps. What they are trying to do right now is basically help their reps make more money. So by taking off some of these, till very recently, their CRM system was effectively an Excel document. And so they're giving, they're giving the reps a lot more tools to kind of remove some of the non-profit generating parts of their business so they can generate more profit, with the idea that you make reps more money, they'll be happier. It'll be easier to season reps if you can get them above that area where they're actually really making a living. So that they're trying to invest in that. And historically, they have not done a great job of seasoning reps at Lawson. One of the things, I actually think this is a more enjoyable business than you give it credit for, because unlike a plumber where you're going to different houses and you're never kind of talking.
It's an emergency. The toilet's broken. Everybody's
everyone's all stressed out. No one's happy to see you. If you're going to see Bob, your buddy at the local repair shop, and you see him every week, you're talking football, you're talking whatever. And they actually said that part of the problem of getting some of the reps to get rid of some of these kind of non-economic accounts is
they're friends. Yeah.
That's my friend Bob. And so
I wasn't trying to fully equate it to plumber. I just meant if it's difficult
to
find it.
I think there's a little more lifestyle enjoyment, but I do think, when we talk about things that need to continue to do well, is they do need to continue to acquire new reps, and they need to do a very good job of maturing them up so that, because eventually some of these older reps will retire. So I do think continuing on the Lawson side and the Jex, and actually on all these sides, because the test equity, their sales force is incredibly technical. People selling, a Keysight machine. I mean, these are high-end engineers. These are PhDs. These are really technical people. And so that is so much of the asset here that when you think about the way this can get broken, is I always think about, okay, what's the key competitive advantage of the business? And to me, it is kind of these rep that they have and the relations they have. So the way I see it getting broken is if you do something in some way that basically hurts that asset, hurts your rep.
Has there been a scaled specialty distributor that you're aware of that has not worked? I mean, I'm sure, again, if you and I went and started a mom and pop with 5 customers, there's a chance that fails. But, has there been a scaled one that you're aware of that kind of hasn't worked or that's unraveled?
So the ones that have generally done worse are the ones that have been more kind of broadline commodity guys. Those are the ones who are starting to really feel pressure from Amazon, feel pricing pressure. In terms of the specialty space,
just quickly define broadline versus specialty.
I mean, so broadline is kind of a lot more of your kind of basic products, like, if you're buying a basic mop or something like that, or, it's really generic. It's the stuff that's Amazon, it's stuff that's more of a commodity product. Whereas if you're buying a private label Lawson fastener, you're not going to find that on Amazon.
It's not Amazonable because, one, again, these fasteners, 30 of them might cost $30. Yeah. So the shipping cost, if you're going to start ordering from Amazon, and then it's more not just the shipping cost, it's the time cost of, a mechanic goes in. Could Amazon launch a specialty distribution in some of these things?
I think Amazon has historically not loved having
it's a people-intensive business. Yep.
Yeah. So Amazon likes having replaceable COGS, not
the fact that we just had a labor shortage, right? And we probably do still have one. So in a labor shortage, your time is very valuable, and these guys managing their mechanics time. If we ever went into a labor unshortage, right, would especially distributors be at risk because we're saying, hey, mechanics, okay, whatever, take an extra 2 hours to go and sort inventory and then go order them off Amazon because, we've got plenty of extra mechanics, wages are coming down. Is that a risk?
I think that actually definitely is. It's a really interesting question because I think they talk about the tailwind of kind of labor shortage and the shortage, especially of kind of skilled industrial labor. So if there was ever a surplus of skilled industrial labor, perhaps then, as you say, the mechanic's time is worth a lot less. I think you'd also have to see mechanic wages come down significantly to offset that. So I think if there was a massive surplus that basically made your mechanic's time, and I'm just using mechanic interchangeably, there's obviously
But then you probably just fire the mechanic, because why do you want somebody on staff doing that versus
Yeah. But I think your point being is, I think what the raison d'etre is to basically save you money and time for your skilled worker. If the skilled worker is no longer as valuable, then maybe their value add is a little bit less, but you still have the kind of many to many issue wherein do you really, if you're XYZ, if you're United Rentals, do you want to manage 7,000 suppliers and, a couple 100,000 SKUs that you need? Or would you rather have someone do it for you?
No, I only ask because, again, so many of these worked. And as my friend said, I've seen these work before. When you buy them at 10 and then you sell them because they get to 11 or something, that's the mistake, right? You want to ride these for multi-year compounding. They're going to trade for a big multiple. Every time you think they've run out, if you found a really good one, they're going to do another good deal. It's going to look great. Yeah. And A, that's a really attractive proposition to me. But B, when somebody says they all work, my first thing is, how does this break? I've been broke before. How do I get hurt?
I completely agree with you. And I do think that is a really important question. And I think, specifically, I think one of the other kind of unique to DSGR challenges is, as you say, it is illiquid. It's relatively complex because while there's a kind of core DNA of these three businesses, you still do have to learn three different businesses. There's, I would call it 2.5 sell-side analysts. One of them has effectively punched on this forever by saying it's, quote, too complex. And so there is the idea of, for us to really benefit from the compounding thing in the public markets, eventually you do have to get a public markets multiple. And the path to that for this one, the path to price discovery here, because of the nature of it, might be longer than it would be for
because especially because LKCM owns so much of it, it's tough because to get more, there's two ways to get more liquidity. One would be them selling, which is everybody's going to freak out if they start selling on the open market. So, you do wonder end game here just because of their huge position there. Yeah. But there is one other path to liquidity. I mean, the company could do a secondary without LKCM selling, or, you could talk the next deal. If the company starts getting a multiple, the next deal is a stock deal. And then that person starts bleeding out over time. So there's paths. I do wonder, hey, if we're sitting here 3 years from now, is this LKCM takes the whole thing in? Do they try to sell it to a bigger company? Would Fastenal or someone hey, this is special distribution? But I do hear, I think it's funny because people email me oh, that's an e-liquid stock. It's hey, as you and I are talking, it's 3:00 Eastern. This stock has traded 40,000 shares at, let's just round it to 30 to make the math really easy, right? So that's $1.2 million worth of value. I'm sure there are listeners who 1.2 million would be a small position for them, but we're talking about something that, if Brad is right, if the management team is right, could multi-year 20%, nothing's invested by, but you could paint a path to multi-year 20% plus IRRs. You could buy a couple thousand shares every day and leg into it for spend a little time for 10 trading days to get that type of IRR. And again, not investing by, but just saying, it's funny. People tell me, oh, look, it's I think you could probably park several $1 million into this if you took a little bit of time.
No, and I think, and you mean, again, it's not investing by, but I do think one of the things you kind of brought up is, LKCM, this is not just they own 70% of this, but this is a rounding error for them. This is 35% of, I think somewhere in there, percent of their fund. This is a fund maker for them. They can't get, they can't really afford to get this wrong. So it's something they deeply, deeply care about the outcome.
And I think the CEO's got interesting strike prices on his options, everything. We probably don't have full time, but everybody is very aligned with getting with me.
Yeah, I mean, just very quickly, we only know this because of the structure of the deal. The only division CEO's compensation we know is Cesar, the CEO of Lawson, and his strikes are 27.5, 40, 55, and 70. And again, we're talking about a $27 share price.
When did those options expire? Do you know?
It's years out. I actually don't remember that off the top of my head, but he got them last year, so I would guess several years from now.
Yeah.
But again, we're still talking. We're talking about 70 is a pretty big number when you're sitting at 27. Yeah. And this is all split adjusted, by the way. Just to remember, there was a 2-1 split for people when you go back and look at the history.
Cool. Well, Brad, I've been wanting to have you on for 2 years now. Finally got you on. I think people can tell why I wanted to have you on. This has been great. And it's going to have to not be 2 years before we get you on again. I want to.
Sounds good, Andrew. I've enjoyed it. Look forward to chatting again at some point. So Excellent.
Perfect.
All right. Thank you so much.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.